Savers or losers? I'm a saver. My parents are immigrants. We're all naturally savers. I'm not saying if you're a saver, you're literally a loser. You're a loser to inflation. You're a loser to groceries going up 70, 80, 90% over 2-3 years. You're a loser to everything inflating except your money, right? So if you have your money in a bank account, let's just take 3-4 years ago before COVID, right? Bank accounts were yielding maybe 1%, maybe a little bit less than that, maybe 0.7%, while stocks were going up 10, 15, 20, 30%, right? So, and inflation at the same time is, let's just call it 3, even though we all know it's not 3, it's much higher than that for day-to-day goods. So by you earning 0.7 by saving and the cost of bananas going up 40% and stocks going up significantly higher than 0.7%, by saving your money, you're losing purchasing power to inflation.
Hey guys, and welcome to Money Talks News, the podcast. In this episode, we're talking about how just about anyone can start investing. When I was an investment broker 40 years ago, investing was a huge pain in the butt. You needed to have thousands of dollars, and you had to pick up the phone and talk to someone like me. You couldn't just do it yourself. Today, though, things have changed. Did you know you can start investing with as little as $5? And you don't even need anyone's help. You can just do it online. And investing is super important. Stocks and other risk assets are one of the best ways to build wealth over time. So today, we're going to help you get started, whether you've got $5 or $5 million. I'm Stacy Johnson. As usual, my co-host will be financial journalist Miranda Marquardt. Hello, Miranda.
Hey, Stacy, I'm ready to start investing with $5 million. You got that for me?
I have that for you. And you're going to get every dime of it at the end of this podcast. Just you have to listen to the entire thing, though.
Great. I'm in.
Also, we've got our producer and a novice investor, Aaron Freeman. Aaron, how's it going?
Good. You guys are going to match each of my contributions, right? Whatever I put in, you match it.
As long as it's $5, I will do that.
Oh, okay.
And today we've got a special guest with us. It is Marko Zlatic. Is that right, Marko?
Correct, yes.
Marko is the founder of Whiteboard Finance. Now, before we start, you guys remember, this is not financial advice. Make sure you do your own research and consult your own experts before acting on anything that you hear on this podcast. Okay, let's dive in. Let's start, Marko, by me asking you why you were here today. What is Whiteboard Finance? What is your background?
Yeah, so first of all, thanks for having me. My name is Marko Zlatic. I run Whiteboard Finance. It's a financial education YouTube channel. So I have almost about 1 million subscribers on there. And it's just a passion project that grew into something much larger. So I got my finance degree in 2010. I started investing in 2006, and then basically just started the channel in November of 2017. So it's been about 6 years now. And I just teach people about, financial basics, basically personal finance, investing, entrepreneurship, and real estate. That's typically what my professional background has been in. And I've been on YouTube full-time since April of 2019.
Cool. I'll be watching you on YouTube. That sounds exciting.
And one of the things I like about Marko specifically is how boring he is. Not boring in a bad way, but boring in the way that he's not out here going like, I'm going to help you make $10,000 by next week, and we're going to do some options trading today. So his content's really great. It's very practical, and it's very approachable, and that's what I like about it.
Thank you.
So, I'm interested in this too. As a matter of fact, I have to tell you guys something too. We're going to talk about how to get started investing with very little money, and this is something I've written about 20 times, because I've been doing this for a very long time. But here's my confession. I don't actually know all the ins and outs of what's happening right now today. The stuff that I've done in the past was old stuff, like before apps came along and stuff like that. So I'm going to count on you guys to school me on how to get started with little bits of money. So now, what are the biggest barriers people face, Marko, when it comes to investing? Is money the biggest?
I wouldn't say so. I think a lot of people don't talk about money or personal finance or investing in general. So if you picture a family of 4 sitting around the dinner table, finance is probably not one of the topics being discussed. So I think a lot of it is intimidation when that doesn't necessarily have to be intimidation.
That's funny. We talked about that a lot throughout our shows. Families don't talk about finances. No, how families don't talk about finances.
Oh, that's true.
Yeah, well, and then I think the intimidation factor is really there too, right? Because it's not something you talk about. It's not something that is real in your life, right? You're not talking about it around the dinner table. It's not high up there. And then it's something that, the language of finance is unnecessarily technical and complicated to make people feel feel intimidated. And then you have all these myths about, oh, I need and part of it, I mean, when I was growing up, when I asked my parents, like when I went away to college and I was like, oh, where can I buy a mutual fund, blah, blah, blah. And my parents were like, oh, well, you need at least $5,000 if you're going to invest in a mutual fund. I'm like, where am I going to get $5,000? And so I think, we didn't talk about it growing up. And then when I asked about it, they're just like, oh, babe, you can't invest until you have at least $5,000. So don't even think about it. And it was like, okay.
A lot has changed. So I started investing in 2006 when I was 18. Now I'm 35, about to be 36. So basically, I remember with Trade King. So if you remember, Stacy, you probably remember this, Miranda, Aaron most likely as well. Whenever you went to execute a trade, it would cost like $19.95, through E-Trade, right? $19.95. So I started investing in 2006. I remember with Trade King. The only reason I went with Trade King, I believe someone bought them. I can't remember who it is now, but basically it was $4.95 a trade. So I'm like, yeah, I'm going to sign up for Trade King. I'm going to become this day trader and become a millionaire, right? So this is before I knew, much or anything about investing in general. But I remember you had to take a photocopy of your driver's license along with these forms that you would print out on your printer. And then you would literally mail it to the company. I believe they're in Florida. And then you'd wait like 2-3 weeks to get accepted, right? To say like, hey, your account's open. Here's your, login information. Now you have, 18-year-olds just picking up a cell phone and, investing with Robinhood, for example.
Yeah, it's really interesting. Well, let's restate what the barriers are. Okay, you've got the technical terms, and the amount of, I'd say, risk probably people are afraid of too, right? And then also thinking that they need a lot of money. How do you overcome barriers like that, Marco?
You go to youtube.com and you type in whiteboard finance and hit enter. And then that's how you overcome literally all those barriers. No, all joking aside, I think it's just education. So, if you ask someone who doesn't know how to change oil on a car, and say, hey, you got to change this oil right now, otherwise, you're not going to grow your net worth. You're not going to grow your wealth over time unless you know exactly how to change the oil of this car. That would probably eliminate 90% of the population, right? Or I don't know how many people know how to change oil or not. But my point is that I think unless people understand simply what they're getting into, I think to Miranda's point earlier, there's just a lot of technical jargon, and a lot of educational terms or education that needs to happen to understand those terms to be able to be confident enough to actually put your money into these investments.
Okay, panel. If I say to you guys, you know what? Why bother? Who cares? I mean, let's take my wife, for example, who I torture every week on this podcast. She goes to work, she makes her money, she puts it in the bank. She doesn't want to deal with stocks. She thinks they're too risky. The terms are complicated. Who cares? What difference does it make? Why should we go to this trouble of learning this process?
Savers or losers.
It is.
Yeah, so savers or losers. So I'm a saver. My parents are immigrants. We're all naturally savers. I'm not saying if you're a saver, you're literally a loser. You're a loser to inflation. You're a loser to groceries going up 70, 80, 90% over 2-3 years. You're a loser to everything inflating except your money, right? So if you have your money in a bank account, let's just take 3-4 years ago before COVID, right? Bank accounts were yielding maybe 1%, maybe a little bit less than that, maybe 0.7%, while stocks were going up 10, 15, 20, 30%, right? So, and inflation at the same time is, let's just call it 3, even though we all know it's not 3, it's much higher than that for day-to-day goods. So by you earning 0.7 by saving and the cost of bananas going up 40% and stocks going up significantly higher than 0.7%, by saving your money, you're losing purchasing power to inflation. So savers are losers in the long term, as long as investments are outpacing what you can get in a savings account. And also, while inflation is higher, what you can get in a savings account, you are literally losing purchasing power to inflation.
Well, that makes sense. It's certainly an argument I used to make all the time and still do make all the time when I'm writing or when I'm speaking. But, some people, it's hard to persuade people Once you, I mean, you can say I understand the facts. I mean, I think actually the most compelling thing you said is that I was a loser. Because the first thing I thought it was like, no, I'm not.
I want to be a winner.
Yeah.
Well, besides that, I think one of the big things you have to get over is there's an emotional element to investing, and a lot of people have a trust problem with the financial institution. My grandparents, a lot of immigrants, they come from countries where you don't trust banks. You don't trust anything. You bury, you take a tin and you bury it in the backyard. How do you get over that?
Good question.
I mean, I think part of it, I think you said mindset. And one of the other issues along with that and not trusting is what's really hard is educating people about the difference between investing, speculating, and gambling. Because like I hear this all the time, just here in my real life, where people are like, oh, if you, they're like, and they talk about, they're like, playing the stock market is gambling. And I'm like, oh my gosh, like investing is not the same thing as gambling. And then people also get overwhelmed with like, how do I pick a stock? How do I pick a winning stock? And for me, a lot of the education is, okay, first of all, let's talk about the difference between investing, speculating, and gambling. And then let's talk about how you don't actually have to use stocks to invest. And then, but it's really hard to dial that back and deal with those emotions and sit down with people and overcome those. And so now I'm going to turn it over to Marco to actually give you useful information.
Yeah, that's a great point, Miranda. So my investing journey was basically this. So as I mentioned, I started in 2006 at 18. And as an 18-year-old, you don't know literally anything about anything. All you know is that, oh, I play soccer, I wear Nike soccer cleats, I'm going to buy Nike stock. Or I have iPod, if you guys remember the iPod. All the young people listening to this are like, what is that? It's an MP3 player. What is an MP3? It's an audio file. So, I'm going to invest in Apple, right? I have an iPod, I wear Nike cleats. So when you're young in your investing journey, there's nothing wrong with buying individual stocks, but my big wake-up call was in college. My personal finance professor, he taught us about spiders, ETFs, index funds, things like that. This is when, State Street and all that stuff started creating index funds and Vanguard. And I've pretty much been, I don't want to say in the Boglehead camp of like the 3-fund portfolio of total stock market, total bond market, and then maybe some international exposure. But that's still, index funds and ETFs make up a large percentage of my net worth to this day, 17 years later. So that was kind of my wake-up call. So to Miranda's point, you don't necessarily have to speculate in the next big, biotech stock or, big tech stock or Tesla or any of these companies. You can choose to make that a percentage of your portfolio, a percentage of your pie. If you look at it like a slice of a pizza, maybe make that 5% of your pizza. But the rest, for me at least, is investing in a total stock market fund, which would be something like a VTI from Vanguard, for example.
Cool. And actually, that's the next thing I was going to say, too. When we talk about investing, that's a really broad term. So what type of investing? Actually, even vehicles for investing. Like my wife, for example, doesn't know a thing about stock market, doesn't really care to know, and yet does have a 401k plan that's partially invested in an index fund. She probably doesn't know that, but she does. So a lot of people may be investing anyway through a company retirement plan, right? So even if that's all you do, that's something.
Yeah, that's a great point, Stacy. There's so many different ways to quote unquote invest. I think that everyone's introduction, similar to the example of your wife, everyone's inherently tied to the market one way or another, especially if they have some sort of employee-sponsored plan or a tax-advantaged plan like a 401k, for example. I think that's where most people's interest in investing actually starts. They're not the 18-year-old, scanning their driver's license to open up a Trade King account. There's someone who got their first big boy, big girl job and realized, hey, I have this thing available to me. It's called a 401k, a Roth IRA, a Roth 401k. So I think that's a very good example.
And, by the way, I want to say one other thing, too. I bought Apple because of iPods in 2001.
Me too.
That's really true. And you know what? I put $1,700 into Apple in 2001, and it's I don't own it all anymore, but I made well over $1 million on it.
Unbelievable.
Yeah, just by holding on to it for 20 years. And that, obviously, I'm not suggesting that I haven't made stupid mistakes in investing, which I certainly have. But there are dumber things to do than looking around you and seeing what's popular and buying that stock. It's probably not the beginning and end of your research on that company, but it's not stupid to do.
No, I mean, Peter Lynch has a great book. Yeah, he basically talks about like, well, my wife buys these, pantyhose. Who's the company that makes these pantyhose, right? It's basically figuring out, what day-to-day stuff that you buy as an average Joe or regular consumer, and then maybe diving a little bit deeper or peeling back layers the onion of those companies.
That's literally where I got that from. That idea from was that book. Do you remember the name of that book?
I think it's either One Up on Wall Street or something like that. Yeah, I can't remember.
Yep, One Up on Wall Street. So if you're out there listening, that's a really good book, and it's really easy to read, and it literally made me a ton of money just by that one suggestion alone.
Yep.
Okay, now let's take a quick break. We're halfway through our show, so we got to pay some bills. We're going to be right back after this quick commercial break. We're going to talk about steps you can take to start investing right now, even if you don't think you have enough money to start. Okay, we'll be right back. And we are back. But before we start, if you appreciate what we do, do something for us. Share the show with your friends and family on your favorite social platforms and subscribe to our podcast. It takes you 2 seconds, but it really helps us. Okay, Marco, tell me, how do I get started investing even if I don't have what I think is not enough money? I mean, I've got $100. What do I do?
Yeah, that's a great question, Stacy. So the order of operations that I work in is a little bit on the conservative side. So make sure that your financial house is in order first. So make sure that you actually understand how much money you have coming in versus going out, aka somewhat budgeting. You don't have to put everything under a microscope, but it's good to have an idea of what your general income and expenses are every month. That way you can determine, hey, I have a surplus of X amount of dollars. Let me invest a percentage of that. So I would then emergency fund, make sure that you have some money saved, similar to Dave Ramsey's advice. And then I would look into all of the tax advantage options first. So you can look into things like, employee sponsored plans, tax advantage plans, HYSAs, HSAs, health savings accounts. And then you can also look into 401ks, Roth IRAs, things like that. What I like telling people is, at least if your employer is offering some sort of match with your 401k, at least invest up to that amount. So let's just say it's a certain percentage on a certain amount and they match a certain percentage of that amount. Just invest up to that. It's free money. And then at that point, look into things like a Roth IRA. Right now, I believe it's $6,500 per year max. And then once you've maxed that out, then you may want to look into taxable brokerage accounts or options that aren't necessarily tax advantaged.
Yeah, and I actually think the contribution limit for 2024 went up. So I think
it definitely went up.
Yeah, I think they both went up for 401ks and Roth IRAs, I believe.
Yeah, so I think for your IRAs, for 2024, we're looking at $7,000.
Nice.
So yeah, you can bump that up when you're planning for your 2024.
Yeah, the nice thing about a Roth is... Oh, sorry, Stacy. Go ahead.
Go ahead.
I was just going to say very quickly to the audience, so with a Roth IRA, the nice thing about it is that I look at it as almost like a glorified savings account. So you can always take out your contributions up to that dollar. So say I put in 10 grand over a couple of years, and that 10,000 becomes 14,000 based on the investments inside of that Roth. You can still take out the 10,000 without penalty. You just can't touch the surplus or the profit, if you will. So then you're limited to 59.5 for certain life events. But the way I look at a Roth is, don't be too scared, because at the end of the day, the worst thing it can become is just simply a glorified savings account.
But one thing I want to underline, Marco, that you said too, is again, this match from your company. I mean, imagine if I told you I had an investment that would make you 50% in one day. Overnight. I mean, that's exactly what a company match. I mean, the typical match is 50% of your contribution up to 6% of your salary. So if you contribute $100 and they give you $50, that's 50% in one day with no risk. And so anyone who's not getting their full company match really needs to think about doing that in any way, shape, or form that they can.
Yep. And the other way that I look at, that's a great example, Stacy, because if you look at it, that's a 50% ROI, tax-free, risk-free. It's just a no-brainer. And if you look at debt the same way, I know this is not an investing question, but just to piggyback off this conversation, if you look at any debt, say, for example, you have credit card debt, and that debt is, 20%. annual percentage rate or whatever. By paying off that credit card, you are making a guaranteed risk-free, tax-free rate of return of whatever that interest rate is. So in this example, it'd be 20%. So sometimes paying off high interest rate debt does make a little bit more sense than investing, but that's more of a short-term solution rather than investment being a long-term buy and hold kind of a strategy.
I want to sharpen the pencil on that. If I'm asking you, Marco, I really want to get started investing. I've got my 401k taken care of. I got my full company match. But I've also got some credit card debt. Should I pay off that credit card debt before I begin any other investing? Yes or no?
Yeah, that's a great question. It really just depends on the math. So, there's a lot of examples of should I pay off my house or should I, invest, right? And to me, coming from a finance background, it's just simply a math equation. Some of it is psychological and you have to account for that. But, if you're paying off a 20% interest rate credit card and you're averaging about 7% in your 401k, let's just assume you're not getting a match. Let's just assume it's a Roth IRA, for example. Then it's a no-brainer to pay off the credit card, right? It's just math at that point. But I will say, I think building the habits to not get into debt first will allow you to propel your investment journey over time and kind of like springboard it. Just because you're not worried about paying off debt, you're just able to invest that surplus into the market or of whatever your asset is of your choosing.
Even though that's not our topic today, I think that's almost more important than investing, to be honest with you, because I don't know about you, Marco, but I know that my other two co-hosts and legions of young people have gotten into debt at an early age. And that's, it takes 20 minutes to do, and it takes 20 months or more to undo.
According to the headlines out there, it's happening again really badly.
Yeah.
Yeah, we're at all-time credit card highs right now. I think it's 1.6 trillion, I believe.
Yep.
But it's not, Miranda, that's not all you, though, right?
No, I mean, I account for maybe half of that.
Yeah, you got 600 billion.
No, but I think, part of that, trying to figure out, when you're going to start investing, what you're going to do, like a lot of people do kind of say, wait a second. And I did start investing when I had, back when I was younger, and my then husband and we had debt, but I still started investing. I still was like, okay, I have a job that offers 401k, so I'm going to go ahead and invest what I can from my paycheck with that. It did not have a match, unfortunately, but I was like, I'm going to invest what I can from that. And then, a couple years later, when we felt like we had got a better handle on our debt and we were paying it down better, and most of the debt we did have, we had a lower interest rate, like it was like low rate car loans and a home instead of a bunch of personal loans and credit cards. I opened an IRA, a Roth IRA, because we qualified, our income qualified us for that, and invested that. I mean, I did it through the insurance agent. And so when I started learning about things like fees and loads, I was angry, but still, it was still, even with the fees and everything, the net gain of learning that lesson and investing and just in getting started and then moving that account elsewhere was still very important, and it still helped me build some capital and start building on my wealth. And so I think a lot of people are scared to start investing even if they have some debt, and it's okay to say like, okay, maybe I'm going to just take I'm going to put most of my income toward most of my discretionary income toward paying down that debt, but let me just save a little sliver of that. Let me save, maybe 5% of that and invest and build that habit and start moving forward.
But speaking of which, let's use that as a transition, because I want you guys to tell me what I said at the beginning of the podcast was I used to tell people how to invest with very little money. But things are different now. It's even easier with even less money. So give me some specifics. Again, we've got our 401k covered. Blah blah blah. I've got some extra money. I've got an emergency fund. I want to do some investing. Don't have a lot of money. Where do I go specifically? What app? What company? What do I do?
I don't know, Stacy. Let's start with what are our affiliates? No, I'm kidding. I'm kidding.
You mean who sponsored that commercial break we just went through?
That's right.
Start with them. That's where you start. Okay. After lining the pockets of our affiliates, Marco, what do you tell people? I was going to say young people, but it could be any people. How do you tell people to start with just a little bit of money? Where do they go specifically?
So that's a great question. I love the candid humor about the affiliates, but one that I actually is an affiliate of mine, but I use them no matter what, even if they weren't. So I like M1 Finance, and the reason for M1 Finance is because I'm a big proponent of dollar cost averaging. So for the audience, if they're not familiar, dollar cost averaging is just investing a certain amount of money at a certain interval. So let's just say, $50 a week, every Monday, for example. And the nice thing about M1 Finance is, I know it's an audio podcast, but I'm kind of putting my hands up in a circle. Again, going back to that pizza analogy or the pie analogy, you can split up your different slices as long as they add up to 100%. So every time you deposit, let's call it $25 or $50 a week, whenever you're making that dollar cost average contribution, you can buy fractional shares of pretty much anything, stocks, ETFs, index funds, whatever. So say, for example, you don't have, let's just say VTI, total stock market ETF or index fund costs $200 for easy numbers, and you're only investing $50, well, you're going to get a fractional share of VTI. So you're still buying into the assets you want to buy into. You don't necessarily have to invest, $1,000 a week just to be able to cover all those slices in the pie. So I really like M1 Finance, and it's a set it and forget it type of investment philosophy.
And I actually also use M1 Finance, and I'm an affiliate with M1 Finance. So yay, Marco, we're going to do a high five through the screen.
Nice.
Another one that I really like, I actually have an Acorns account, and I like it because it does the roundups. And so it'll actually automatically take your pocket change, round it up, and then invest it. And so for me, I use it as sort of this like my spontaneity thing. So I'm like, I'm looking forward to maybe I want to do a getaway or something, and I'll just open up the old Acorns and see what my pocket change has got.
Do you really get that much in there just from rounding up your purchases?
It's not enough for me to go on a lavish vacation. It didn't pay for China this year, but it'll pay for what I have in M1 Finance helped pay for China this year. But no, if it's something small, if I'm I just want to do a 3-day getaway to Lava Hot Springs and pay for the hotel, pay for the massage, pay for my dinner.
Just from rounding up your purchases, you got that much money in there?
Yeah, I can do that every few months. Yeah.
Wow, that's cool. That's a good idea. And
it's not just purchases. It's other things that you do. They'll connect to your bank account. And
no, I thought you meant
things.
Literally when you go to the 7-Eleven and something costs $1.80, the 20 cents goes into the account. And I was thinking, you must have to do a lot of spending.
That's part of that too. Yeah, that's part of that too. But you can also turbocharge them. Mine is actually set to 3 times. So
okay.
if I spent $5.80, it rounds up to the 20 cents, but it actually takes out 60 cents. And but if you're going to do something like that, you got to make sure that you have that buffer in your accounts. But but I can connect all sorts of things to it, and it'll if I transfer money from my business account, and it gets taken out of the business account to pay my son who's on my payroll, and goes through that process, it still rounds up. It's connected, it'll round up. It doesn't take it out of my business account. It's the funding account is a personal account. I want to be clear about that right now. I'm not funding my personal investment account with my business account. I want to make that very clear. That is not a thing that's happening. This is not LLC TikTok, people. I'm not telling you to do that.
LLC TikTok.
So I have a question about these apps, but before I do, Marco, I have to tip my hat to you. Not only did you promote your YouTube channel on this podcast, you promoted the sponsor of your YouTube channel on this podcast.
It's an affiliate, so there's no compensation unless you go exactly to Whiteboard Fight. No, I'm just kidding.
No, actually, I would prefer you to use my affiliate link.
That is really funny. Well done. But here's a question I want to ask you guys about these apps, because I've never used one. Does it cost money? I mean, it must cost something, right?
That's a good question. I think with M1 Finance, I don't know if they take like fractions of, every transaction. I don't think they do because I think it's 100% fee free. I just don't know if the arbitrage between the time you buy the asset you want to buy versus when they buy it, I don't know if they're making a spread on that. But ultimately, the goal is for them to get a lot of assets under management because they offer other things like, checkings accounts, savings accounts, credit cards, things like that.
So they're not charging you $20 every time you use the app. I mean,
it's
they
free.
may be making a spread. So no commission on the trades.
No, sir.
Not that you see anyway.
No, exactly.
Right. And so like, and I am actually signed up for their premium. And so
Same.
I think it's $100. So basically I pay an annual fee of $125.
Oh, okay. So that's not nothing.
Yeah. But it's not bad, and but that allows me access to their other like bank like products, the saving, the spending. You can even get a decent interest rate on a loan against your portfolio. That's a whole other thing. That's not something we need to talk about today. But but like it does, it does provide other services.
Yeah, their high yield savings account has been 5% for months now, when my Capital One is like 4.3. So if you just do the math on that 70 basis points, the 0.7% difference, I mean, you can figure out, hey, is this annual plan worth it? So yeah, their savings account is really nice.
What other apps are there? I don't want to put you guys on the spot and make you list everything there is, but I've heard of Robinhood a lot. Is that a good app?
I think if you're a complete beginner, the user interface and the user experience is the best out of all the apps. It's just very simple to understand what's going on, especially that reduces that intimidation, maybe even education factor that we talked about earlier in the show. But some of their practices over the past, year and a half have really turned a lot of people off to them. During the whole GameStop, AMC saga and all that stuff. So we don't need to go into that. But as an app itself, I think it's a really well-done app with a great user interface.
Yeah, and I think the key with using Robinhood, especially as a beginner, is to once again, if you don't want to be picking stocks, look for the ETFs. They have plenty of index ETFs that you can get into. They also offer the fractional, and you can set up that dollar cost averaging that Marco was talking about earlier with Robinhood, and do so very easily, and then just leave it alone. I know that Robinhood has kind of gamified it a bit, and it makes it fun to trade, but let's not, as beginners. Let's be boring.
Yeah, that's actually a good thing to say too.
Let's be boring for a little while.
Yeah, and you mentioned that, Marco. You mentioned at the outset of this podcast that you were a day trader. Are you? I don't want to put words in your mouth. You said day trader, traded a lot, or something like that, right? And
no. I was just giving an example of. I know what you're alluding to. No, I'm not a day trader. I'm the exact opposite of a day trader.
Yeah.
I am a decades plus long-term buy and hold. I think, day trading, there's a time and place for swing trading. Day trading to me is not something that I would delve into, especially as a beginner, but swing trades do make sense. But for me, mostly I'm just a buy and hold. Sorry?
Swing trading, you're saying?
Yeah, swing trades, maybe like couple weeks, couple months. If you know something's happening with like, interest rates or some new technology or, I don't know, cobalt mining affecting batteries, whatever, GameStop. Yeah. There's a bunch of different things. But I think even COVID was a great example, cruise lines, airlines, all that stuff. That could be a swing trade, but I'm not holding, American Airlines or Jets ETF for years, maybe just during the time of COVID, okay. Right? So swing trades are okay, but yeah, I'm a long-term buy and hold investor.
Yeah, I was going to caution people about that too. I've yet to meet a successful day trader. I live in South Florida, and there's a lot of swing trading going on, but it's not that type. Anyway, any last comment? I really want you to convince me, Marco, in a sentence or two, why I need to do this and why I need to do it now. Why do I need to be investing?
Yeah, I think your older self will thank you. As long as you look at the trends of at least the American economy, yes, there's a lot of stuff going on geopolitically and all that stuff, but that happens every generation. History is on your side when it comes to the market, at least if you're investing in the right things. And at the end of the day, with inflation and with savings accounts yielding what they're yielding, stocks have historically outperformed that. So if you want to maintain purchasing power, you still want to be able to afford the banana 50 years from now. That's why investing is important, because it keeps your purchasing power intact for most scenarios.
Awesome. Well, just to let you know, my older self is dead.
Maybe even me, man. I don't know. We'll see.
Deader than disco. Yeah, you never know. Anyway, folks, we are out of time on this podcast, but we are never out of topic. Dig a little deeper. You're going to find links to lots more info in our show notes. And remember, if your goal is to make more, to spend less, to retire rich, your online home is moneytalksnews.com. And don't forget to check out Miranda's online home as well. That is Miranda Marquit, MARQUIT.com. And of course, you want to visit Marco at his website. That is whiteboardfinance.com. But you can also just go to YouTube and look up what, Marco?
Whiteboard Finance. And also, we have a private community called WBFuniversity.com. It's a great resource. I don't want to plug it too much, but check it out.
Marco,
we'll have links in the show notes.
Yes, we will. But is there anything else you want to plug before we go, Marco?
No, I think this is a great show.
You got it all covered?
Okay. Yeah, I appreciate you having me. Thank you so much.
Okay. And one last thing, folks. If you do appreciate what we do something for us. As I said before, subscribe to the podcast. It takes you a couple seconds, really helps us out. So if you like us, show us and subscribe. I'm Stacy Johnson.
I'm Miranda Marquit.
I'm Aaron Freeman.
And thanks so much for being here with us today, Marco. We really enjoyed having you. Please come back again.
Thank you so much.
And thank you, folks, for hanging out with us. And we're going to see you right here next time.